all of the events that we've seen in the United States, the events that we've seen now in Europe with Credit Suisse, and I suppose a little bit of the, if you're just looking at the market pricing, a little bit of the lack of confidence last week perhaps for banks, is there any big fear or any big real risk in India that, you know, we've got the same kinds of unrealised losses that are just sitting on balance sheets?
I think you have to look at India very differently. And the straight answer is, I don't think so. If you look at the real issues, first of all is really the quantum of funds that either SVB or anyone else in the US put into the government bonds. Yeah, it was pretty substantial as a part of the total investments. Second, the duration. And third, the nature of the deposits, which were largely wholesale. If you come to India, and I take each one of them, you know, you have an SLR of about 18%, and there is a cap on how much of that SLR, which is 23 to 25%, you can put in hold to maturity, which is HTM. So there's a cap that the RBI puts, and therefore the rest is in AFS, and banks manage that very well. Secondly, if you look at the nature of deposits in India, the retail granular deposits for most banks, the large banks, etc., are anywhere from 40 to 50%. And thirdly, the duration is relatively shorter for the banks as compared to the US. Lastly, the quantum of interest. See, US went from 0 to 5%. That's pretty sharp. In India, you've seen a total 250 basis points hike. So if you put all these factors together, in fact, Indian banks are looking very different from the rest. Lastly, there has been credit growth in India, and if you see very strong growth for the last 18 to 24 months, and banks have actually been deploying money into credit. So the quantum and the proportion of the balance sheet and investments, the duration, the nature of the wholesale deposits makes Indian banking sector very different from what we have seen happening in the US.
And I agree with you on that front. And I suppose the question is, there were, you know, a number of expectations that this was going to be a really, really stellar year for the Indian banks. And I suppose the private banks in particular, particularly on the EBITDA front, on that growth front that you mentioned, you know, credit growth continuing. Do you think that there's in any way, shape or form, perhaps not the risk of collapse of Indian banks in the same kind of a fashion, but do you think there's going to be a little bit of slowing down just as a second order, third order knock-on impact, or is it relatively ring-fenced in that respect?
So there are 2-3 things that can impact that. First is the macros. Right now, the macro in India, including our current account deficit, is looking in reasonable shape. And with oil in control, which is one of the key things, India is looking pretty stable. The government has committed in their budget to spend about 10 lakh crores on capital expenditure. If that happens, that will spur growth. So in my mind, the number one thing to watch out for, is there likely to be any slowdown in growth at 6.8 to 7% this year and estimated around 6% next year? It still looks fine. Second really is the liquidity in the banking system. I think right now there's adequate liquidity, and the Reserve Bank of India watches the banks and regulates it very closely. And I think that is comfortable as of now. I already talked about the deposit composition and the demand for credit. Consumption is still driving the credit and is reasonably strong. So the way I look at it, the macro factors in India are okay. If at all, it will come in from the global situation. If the global situation worsens, capital flows completely stop, then India could sort of, slow down on the growth front. And if there is a slowdown in the growth front, banks could get, could see some impact.